the fact that we had some more aggressive selling earlier this week, that could take away some marketing pressure for the next several weeks.
Hi once again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Thank you for joining us today as we recap the week's trading activity. My very special guest today is Joe Camp of Comstock Investments. He joins us to wrap up what happened during the trading week. Well, it wasn't necessarily a great finish to the grain trade here on Friday, Joe. And even in the livestock markets, we appeared to have kind of a mixed bag. So what was affecting the grain trade? First of all, let's focus on that.
So promising early on in the week. We were on the verge of a major technical breakout for corn futures, and that comes into play the resistance that was met following the crop report. The crop report was the fundamental spark that had led the bulls to this latest attempt to break through this recent high. I mean, we've been showing these charts about how this narrowing wedge had been forming, and it's either break out or break down. And those speculators, which have been now newly net long in the corn futures and options, they were again right there, a penny short of the October high, 452 and a quarter. We ultimately ended up lower after that initial surge following the report day up on Wednesday, and then selling after that. The momentum failure there really key, bringing out more technical sellers for one, but also more farmers selling for two. You've got those things meeting here earlier in the week to really show up as a hefty pushback and ultimately turning the board lower. So again, some speculative profit taking / chart selling that was joined by another round of pretty healthy farmer selling out there.
Okay, so all in all, when you look at the daily corn chart, we'll go with maybe the March. It's looking kind of toppy, and like you were talking, we got right to the 200-day moving average, backed away from it right now. Now what? I mean, how concerned are you that we'll see follow through on Monday now?
That's the weaker finish to the week, portending to what would very easily be something we could see in a weaker start next week. But yet, at the same time, we know we've got Saturday and Sunday and whatever developments to occur over this weekend, still to shake loose possibly the Monday session in a different direction. And I say that knowing that it is this Friday type of trade where you have the lighter volume, felt like market participants really wanting to get out of this week and see what happens these next few days. It's politically driven. There are some reports here late on Friday about Congress coming together on some outstanding issues like funding the government, otherwise to be shut down on the 20th next week. You've got open items such as hurricane disaster relief. You have from the Treasury Department still awaiting that guidance on the 45Z clean fuel production credit. You've got a lot up in the air here still within this next 2.5 weeks before the calendar year closes. And that's why we don't necessarily have to think that today's down day makes for the trend the rest of the year. We'll see.
Well, we talked about the chart pattern on the corn, but if you look at soybeans, we've been talking about that for quite a while. It's in this real long downward, downward trending wedge, and it just chops around and meanders around sideways there. But is there a concern that the bottom edge of that wedge formation may be taken out? I mean, there's a lot of talk about record crops coming out of South America, and they're not all that far away anymore.
That's the immediate threat. It was the case we were thinking, okay, corn can be the leader. And if you're going to observe that important of a technical breakout, like we had the chance at seeing earlier in the week, that can be what lifts the soybeans and the wheat too, for that matter, from their contract lows. Now that you have the failure on the corn end of it, it's more of a risk, it would seem, that the soybeans and the wheat do drop to new lows, and ultimately they pull down corn with it. And that is what is the deciding factor for having these large speculators, the hedge funds, flip back from being net long the corn to net short, where they still are for soybeans and wheat. So you mentioned the charts. Yep, we're right back there down at recent contract lows. And for soybeans, you fall to a new low, you don't have much until $9 even. Below that, there's even more risk down to the 2019 lows. For wheat, you've got a maybe quick drop towards $5 in Chicago. If you give up roughly this 5.25 to now 5.50 area for the now prompt March month, it's just a bad look here as we go forward, maybe negating what could otherwise be some bullish expectations about how we normally finish the year out. December, and especially the back half of December, coinciding with that so-called Santa Claus rally that sometimes expresses itself in the stock market. And for others, you have that potential, but very much in doubt all of a sudden after the poor finish this week.
Sometimes it's Santa Claus, sometimes it's a Grinch, I guess. Wanted to ask you about the soybeans. Didn't you tell me earlier today that we had some flash export sales of soybeans? If that's the case, wouldn't that be especially bearish if it couldn't rally on that?
That was the thought here this morning, that down overnight for the beans, but possibly ready to open up after the hard open, that 8:30 Central restart with some strength because of what we observed in that 8 a.m. flash sale. The USDA reports on a daily basis any grain sale of more than 100,000 tons. This was a couple 100,000 tons, and more importantly, it followed up from more than 300,000 soybean sale made in the previous session. Now, we look at those and we think it's likely China still buying, but we yet aren't convinced that they're buying still anything beyond February, trying to get what they can shipped not only before the new U.S. government takes office and potentially adjust those trade policies, some new tariffs on China, and just as importantly, they know that after February, they're going to have beans filled into the pipeline from South America, Brazil already.
So how are the funds positioned here as of, well, this would be as of last week, I guess, on the soybeans right now?
I'd call it moderately net short. It's not a record bearish bet by any means, but it continues to be decidedly negative. The same could be said for wheat. Chicago and Kansas City futures, the short pretty sizable, but not record. There is a new record net short just reached by hedge funds on Minneapolis wheat futures. So the split there, again, makes us think that something's got to give. Corn turning more bearish with the rest of them, or the other way around. Finally, that you just can't break the new contract lows for as many times as the bears have had their chance. And so it's time to start short covering and to get a little bit more optimistic potentially heading into the new calendar year. But a couple of weeks left to determine just that type of direction. These speculators making the decision on how to be positioned heading into 2025. Farmers as well. That's going to be important too. Maybe the fact that we had some more aggressive selling earlier this week, that could take away some marketing pressure for the next several weeks in a manner that supports prices. Watching those trader positions and the ebb and flow between the speculators and what the farmers are doing is going to remain really important.
You know, the wheat market, even though it seems like it wants to give the impression like it's finally getting traction, but it keeps slipping on that banana peel, and it's playing footsie with that 20-day moving average all the time.
It was a broken record where we were saying, okay, Russia, their prices are down, the French market's weaker, that's going to continue to weigh on U.S. wheat prices. And then it got to be, okay, the Russian government stepping in, they're implementing a price floor, they're having crop troubles, they're going to have a much smaller crop next season, it would seem. Same thing with Ukraine, similar for the European Union broadly. That would all be bullish, but then all of a sudden, the focus shifting to what's going on in the southern hemisphere and these really big crops, one shaping up in Argentina, and that fits with the really ideal weather across both Brazil and Argentina right now, but also in Australia, you have a big wheat crop shaping up and higher estimates, it would seem, each day to dampen what was otherwise some enthusiasm for buying a couple of weeks ago.
I want to take a look at the livestock side of the ledger here as we wrapped up the week. The cattle market just really had something for everybody, but I mean, it was one of those Pepto-Bismol days, where it was really, really choppy. It was a rough ride. Here you had live cattle, the fat cattle ending up higher. I mean, they're up there around some long-term highs now. Feeder cattle, they look for all the world like they were going to reverse out and go sharply lower, and then they kind of clawed their way back a little bit. I don't know if you look at that as a good thing or a bad thing on the feeders, the way they closed.
It starts with some simple spread unwinding in my mind. We know about the feeders and their position above the live cattle, having reached back towards nearly a record premium. So you have some of that adjustment into the end of the week, but then just simply more positive news for the fed cattle as opposed to the feeders. And that would be, for one, the morning cutout report. And it was up again, just slightly higher for the choice, a couple of dollars more for the select, but more bullish was just the simple fact that we had held the surprising gains from late yesterday, jumping more than $4 for the choice average. We now have choice and select beef roughly 9% above where they were at a year ago. And the higher beef prices tracked right along with the cash trade, holding up really rather firmer than expected here. So as the week carried forward, those fundamental drivers continued to really underpin the bullishness, and it convinces the speculators to hang in there and defend their positions when they're reading these fundamental news bits that are so positive. And I bring that up because we talked about where the funds are on the grains. Well, they're at or very near it. New record net longs for both live cattle and feeder cattle futures. So for now, just that breather on the feeder cattle, as you noted at the end of the week, but the strength at the close for live cattle makes us think that the rally's still on.
Well, on feeders, it looks like a double top, but is that a thing in feeder cattle or not?
Yeah, it could be. A lot of times you think more about them making an inverted V spike top and not having that second chance like we may be observing here. So for now, you have to think that those highs are still in play, and that as the speculators are defending these newly historic net long positions, that there's still upside to go here. We'll wonder, though, seasonally, too, if something could maybe cause a few wrinkles now that we are transitioning past the holiday season. On the flip side of that, you look at the futures market, and the seasonal patterns through the last couple of weeks are normally bullish, but maybe that goes back to what we were talking about with the stock market. Are the cattle also dependent on a Santa Claus rally and other markets finishing the year with strength? We'll know more about that already starting next week, because you've got not only the political developments that we would expect to hear on again, but the Federal Reserve meeting on Wednesday next week, and a lot more to come to determine whether or not we've got the environment still for speculators to push these cattle futures to new highs again.
Okay, on the lean hogs, we have a good news, bad news scenario. First, the bad news. It looks like on the nearby lean hog contract, the futures took out the bottom side of the upturning channel that they've been trading in forever, the way it seems like, since probably early August. They took out the bottom side of the channel. They went down and tested the looks like the 50-day moving average, and it held, and it's hit it several times in a row, hasn't taken it out. That's a good thing. And then we closed higher on the day. That sounds pretty good. What about a weekly close? Is that positive or negative here?
It is positive. We have to split out a bit the different contracts, noting that December has had relative strength, at least leading up to today. December is important to talk about because today was its expiration day, and you did have convergence up towards the cash index. Now you have the February contract now prompt a couple of dollars almost of a premium to the just left December contract. And I bring that up because the February contract doesn't necessarily look quite as strong. Today, you had an outside reversal up, but the settlement was just short of the 20-day moving average for the February contract alone. So we really are split between a kind of will they, won't they, and it goes right back to how those speculators are positioned. Same with the cattle. They last week were reported to have another new record net long in the hog futures. So until there's something really convincing out there to tell those traders to ditch the position and head for the exit, they're going to try to get what they can out of this market, and to push it further would be supported still by, like cattle, what the speculators see in the fundamental dynamics for the hog market, that including the pork cutout, like the beef did today. All of a sudden, you get a big jump this morning, led by the bellies, and traders take note of that.
Interesting stuff. I know sometimes if markets tend to kind of turn sideways, sometimes that means a change in momentum or direction. And it's hard to get a read on these hogs right now. I mean, they are at pretty lofty levels, but I guess we'll see what they want to do immediately before a big holiday like that. Anything on the outside markets that you wanted to comment on before I let you go?
I mentioned next week and this lead up to the Federal Reserve meeting. That will take place with a decision coming out on Wednesday afternoon. That can lead to a course correction depending on the outcome, and probably more importantly, the comments from Fed Chair Powell after the fact. We have the market all but certain we're going to get another quarter-point interest rate cut, but how will the outside financial markets react to how we view future interest rate expectations, and what does that mean for not only the stock market, and do we have support for that end of the year rally? What does it mean for the currency market and this dollar that's gotten still so strong in a way that could be detrimental long-term to export prospects for grains and livestock? And then back to the broader commodity space as a whole, these big downside corrections occurring this week in the metals, gold and silver. Will that shift course? Ultimately, it will be important whether or not, again, the environment created by these outside market stocks, bonds, currencies, metals, do they support finishing the year strong? Or is there enough nervousness that develops in these other markets that spills over such that we have almost no chance to recover this bullish leaning that we had earlier in the week on grains? Again, a poor finish, but maybe subject to change depending on all of these moving parts starting next week.
And I'm going to guess in the next week or so, we're probably going to start seeing declining volumes in the markets, aren't we?
Could be the case. You get traders home for the holiday and ready to close positions, book profits, and then decide on what to trade once 2025 begins.
Well, it's great to talk with you, Joe. Thanks for analyzing what took place this week in the markets. Always good to visit with you. We'll catch you again next week. That's Joe Camp. He is with Comstock Investments, and appreciate you being with us. That'll do it for this episode. For producer Brianne Jenkins, I'm Marlin Bohling. We'll catch you next time right here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.